If you had just $100 and you wanted to turn it into real money, where would you actually put it? That question gets asked more than almost any other question in personal finance, and most answers online are just guesses dressed up as advice. So instead of guessing, let's look at something real. A few years back, someone ran an actual test. They took $100 and split it 5 different ways, into 5 of the most common ways beginners try to grow their money. That money has been sitting there ever since. Today, we're opening up the results together, one investment at a time, and by the end, you'll know exactly where your first $100 should go. Before we open anything up, we need a fair way to judge each option. Guessing which investment is best without a system just leads to opinions. So we're going to score every single one using the same 5 categories. Learning curve. This is how much you need to study before you can use this investment well. Short is better here, because most people give up on things that feel too hard to learn. Passive income potential. This means how much money the investment can pay you while you still own it, without you needing to sell anything. Think of it like a plant that grows fruit on its own, instead of one you have to chop down to get any value from it. Tax efficiency. Some investments come with special accounts or rules that let you keep more of your profit instead of handing a chunk to the tax office. Others don't get any of these perks. Risk level. This is simply how likely you are to lose money and how much the value could swing up or down along the way. Results. This is the fun part. We'll reveal the real return after several years and exactly what that first $100 turned into. Before we get into it, one quick note. None of this is personal financial advice. These are general examples meant to teach how different investments behave, not a recommendation for your specific situation. Rules around taxes and accounts change depending on where you live. So always check with a professional or do your own homework before putting money anywhere. Alright, let's open the first envelope. Buying an individual stock means you're buying a small piece of one company. Maybe it's a company that makes phones or sells shoes or builds software. Whatever it is, you now own a tiny slice of it, and if that company does well, your slice becomes worth more. Learning curve, high. Picking individual stocks well isn't just picking a company name you like. You need to actually read into how the business makes money, how much debt it carries, who's running it, and whether it has real staying power. People who do this seriously will look at financial statements the same way a mechanic looks under the hood of a car before buying it. A smart way to practice this without risking real cash is to use a trading app with a demo mode, where you can test out stock picks using pretend money first. Passive income potential. Good. There are 2 ways a stock can make you money. First, the price can rise while you hold it, so you can sell it later for more than you paid. Second, some companies pay dividends, which are regular cash payments sent straight to anyone who owns their stock. Not every company pays these, but the ones that do are basically paying you just for holding on. Tax efficiency? Great, if you use the right kind of account. In the UK, there's something called a Stocks and Shares ISA, and in the US, there's a Roth IRA. Both let your profits grow without the tax office taking a cut, as long as you follow the rules for that account. Just remember that tax rules shift depending on where you live, so this is another spot where checking local rules matters. Risk level, high. Here's a story that shows exactly why. Back during the dot-com boom in the 1990s, plenty of everyday investors picked stocks that shot up fast. Some of those same investors made real money by selling at the right moment. But many of the companies they were excited about didn't survive the crash that followed, and some of those stocks became worthless almost overnight. That's the danger with individual stocks. Betting everything on just a few companies means one bad outcome can wipe out a big chunk of your money, even if your overall strategy made sense on paper. So here's how the test worked. 20 well-known stocks were written on a board, and a blindfolded dart throw picked which one got the $100. The dart landed on a large electronics company. Fast forward to today, and that $100 stock position is worth $67.62 once a small dividend payment gets added in. That's a loss of about 32%. Rough result, but it tells an important story on its own. To put that in perspective, if that same dart had landed somewhere else, the outcome could have looked completely different. A $100 investment in a major phone and computer company from that same starting point would now be worth around $170. Landing on a software giant would have turned it into roughly $188. And landing on a leading chip maker would have turned that same $100 into more than $900. Same amount of starting money, same amount of time, wildly different outcomes depending purely on which company got picked. That's the real lesson with individual stocks. This is not something to leave up to luck. If you're going to buy individual companies, you need a real plan, real research, and the patience to hold for years, not weeks. Even then, the market can still surprise you in ways nobody predicted. If someone still wants to try picking individual stocks after seeing all this, the smartest first step is practicing with a demo account before putting in real money. Most investing apps offer this, and it lets a beginner test out picks, track how they would have performed, and get comfortable reading company reports without risking a single dollar. Only once that feels natural does it make sense to move over to real money. And even then, spreading that money across a handful of companies instead of just one is a far safer approach than picking a single stock and hoping for the best. Real estate investment trusts, usually just called REITs, let regular people invest in property without ever buying a house themselves. Picture this. Imagine 3,000 people each put in $100. That pool of money adds up to $300,000, enough to buy an actual building. That building gets rented out, and the rental income gets shared among everyone who chipped in. Nobody owns the whole building alone, but everyone owns a piece of it and a piece of the profit. Learning curve, moderate. You don't need a mortgage, a real estate agent, or a giant down payment like you would with an actual property purchase. But you do need to understand what kind of properties the REIT actually owns, because that changes everything about how it performs. Some REITs own offices, some own shopping centers, some own apartment buildings or hotels, and each of those categories behaves differently depending on what's happening in the economy. Passive income potential. Great. REITs are required by law in many countries to pass along a huge share of their profits, often 90% or more, directly to the people who invested. That means steady, reliable income as long as the properties stay rented and the tenants keep paying. Most business tenants sign long leases too, which adds even more stability to that income stream. Tax efficiency. Great. In places like the UK, REITs can be held inside tax-sheltered accounts like a stocks and shares ISA, which means the income and any gains stay untaxed. As always, the exact rules depend on the country, so it's worth double-checking locally. Risk level, medium. Because a REIT owns many properties instead of just one, the risk gets spread out. If one building underperforms, it doesn't sink the whole investment the way owning a single property would. Still, REITs aren't risk-free. If an entire sector of real estate struggles, like commercial offices during a widespread shift toward remote work, the whole REIT can lose value along with it. Here's how it actually played out. That same $100 test put money into a commercial property REIT 4 years back. Today, that investment is sitting at $98.59, a small loss of about 1.4%. Mostly because commercial office space took a hit during a rough economic stretch. But once dividend payments are factored in, nearly $2 extra landed in the account, bringing the real total to about $110.52. That works out to a positive return of roughly 10.5% overall. Not flashy, but a solid reminder that dividends can turn a losing position into a winning one over time. So what's the takeaway here? REITs aren't guaranteed to be smooth sailing, but they tend to be steadier than picking single stocks. And the income part alone can carry a mediocre investment into positive territory. For anyone curious about trying this themselves, the easiest starting point is picking a REIT based on the type of property it owns, not just its name. A REIT full of warehouses used for online shopping deliveries behaves very differently from one full of office towers sitting empty after a shift toward remote work. Reading a quick summary of what the fund actually owns before buying in takes just a few minutes and can save a lot of disappointment later. Cryptocurrency is digital money that doesn't run through a bank or a government. Coins like Bitcoin and Ethereum run on something called blockchain technology, which is basically a shared digital record that's extremely hard to fake or tamper with. Crypto has made some people incredibly wealthy, with Bitcoin often called the best performing asset of the last decade. But it's also wiped out fortunes just as fast. It sits somewhere between an investment and a bet, and it's definitely not for anyone who gets nervous watching numbers swing wildly. Learning curve, moderate. First, you need a wallet, which is just a place to store your crypto. Online wallets are convenient but need very strong security. Offline wallets, sometimes called hardware wallets, are safer because they're not connected to the internet at all. Next, you need an exchange, a platform where you actually buy and sell coins, with names like Coinbase and Binance being some of the most common. Finally, there's the idea of tokenomics, which is just a fancy way of describing how much of a coin exists and how that supply affects its value. Bitcoin, for example, has a hard limit on how many coins can ever exist, which is part of why people compare it to digital gold. Passive income potential. Moderate. Crypto doesn't pay dividends the way stocks can, but there are other ways to earn from it. Staking means locking up your coins to help support the network. And in exchange, you earn rewards. Yield farming means lending your crypto out to others and earning interest, similar to how a bank pays interest on savings. Both of these methods can pay off, but they also carry extra risk, since a coin's value can drop suddenly or a platform could get hacked. Tax efficiency. Poor. In many places, even trading one crypto coin for another counts as a taxable event, and rewards from staking often get taxed as regular income too. Crypto usually can't be held inside the same tax-sheltered accounts that stocks and REITs enjoy, which makes it one of the least tax-friendly options on this list. Risk level. Very high. Prices can jump hundreds of % in a single year, and just as easily crash the same amount. Sticking to well-established coins like Bitcoin and Ethereum is generally seen as less risky than chasing smaller, newer coins, but less risky in crypto still means genuinely risky. On top of price swings, scams are common since the space isn't tightly regulated, so protecting access to your wallet matters just as much as picking the right coin. Now here's the number everyone's been waiting for. That original $100 went into Bitcoin 4 years ago and was left completely untouched. Today, that same $100 is worth $652.24. That's a return of over 550%. It's an incredible number, but it comes with a big warning label. Bitcoin has been the standout performer of the last decade, and most cryptocurrencies never come close to matching that kind of growth. Plenty of coins have lost all their value entirely. Crypto can absolutely build wealth, but it demands a strong stomach and a real understanding of what you're holding. Treat any huge win here as the exception, not the expectation. Anyone thinking about dipping a toe into crypto should treat it the same way they'd treat a small, calculated gamble rather than the core of a savings plan. A common approach among cautious beginners is only putting in an amount they'd be completely fine losing, sticking to well-known coins instead of unproven ones, and keeping funds in a secure wallet rather than leaving everything sitting on an exchange, since exchanges can be targeted by hackers. 2 down, 3 to go, and the results have been all over the map so far, from a stock that lost nearly a third of its value to a crypto bet that turned into hundreds of dollars in profit. So which investment ends up being the steadiest? And which one quietly outperforms almost everything else on this list? Let's keep going. Gold has been used to store wealth for thousands of years, long before stocks or digital coins ever existed. It's often called a safe haven, meaning people tend to run toward it when the economy feels shaky or when inflation is eating away at the value of regular cash. Learning curve, low. There are really just 2 simple ways to buy it. Physical gold, meaning coins or bars, is the most direct option, though it does need somewhere safe to be stored. The second option is a gold ETF, a fund that tracks the price of gold without requiring you to hold any actual metal. These can be bought and sold in seconds through most investing apps. Passive income potential, 0. Gold doesn't pay dividends, interest, or any kind of income at all. It simply sits there and either holds or changes in value. It's a store of wealth, not an income generator. Tax efficiency, good. In some countries, certain gold coins are treated as legal currency, which can mean no capital gains tax when they're sold. Gold ETFs are usually simpler, and in places like the UK, they can be held inside a stocks and shares ISA to keep any profit tax free. As always, rules vary a lot depending on where you live. Risk level, medium. Gold tends to hold its value well during uncertain times, which is exactly why so many people turn to it. The trade-off is opportunity cost. While your money sits safely in gold, it's not growing anywhere near as fast as it could in something like stocks or crypto. Here's how the test played out. That $100 went into a gold ETF 4 years ago and was left alone. Today, it's worth $140.10, a gain of about 40%. It's nowhere near as dramatic as the crypto number, but it shows exactly what gold is supposed to do. Slow, steady protection rather than explosive growth. Gold works best as one small piece of a bigger plan rather than the main event. Think of it as insurance for a portfolio. Nobody buys home insurance hoping to use it, but everyone feels better having it in place. A small slice of gold sitting alongside other investments can soften the blow when riskier assets have a rough year, without dragging down long-term growth too much. An index fund is a single investment that holds a huge basket of companies all at once. Things like major tech companies, retailers, and manufacturers all bundled together. Instead of betting on one company, you're essentially betting on the market as a whole, moving upward over time. Learning curve, low. There's no need to study individual company reports or pick winners yourself. The fund already spreads your money across hundreds, sometimes thousands, of companies. Most investing apps let you buy into one with just a few taps. Passive income potential, moderate. Index funds don't chase big dividend payouts the way REITs do, but many of the companies inside them still pay dividends. And that income usually gets reinvested automatically or paid out to you, depending on your settings. It's a nice bonus layered on top of long-term growth. Tax efficiency, great. Held inside accounts like a stocks and shares ISA or a Roth IRA, both the growth and any dividend income can avoid taxes entirely, which adds up significantly over many years. Risk level, low, relatively speaking. Because your money is spread across so many companies at once, one company struggling barely makes a dent in the overall performance. Historically, broad market index funds have returned somewhere around 8 to 10% per year on average over long stretches of time. Short-term ups and downs still happen, but holding for a decade or more has historically smoothed most of that out. So here's the final reveal. That $100 was placed into a broad market index fund 4 years back and simply left alone the entire time. Today, it's worth $179.57, a return of nearly 80%. No dart throws, no wallet security, no digging through financial statements, just one simple purchase and years of patience. This is exactly why so many financial educators point beginners toward index funds first. There's no need to guess which single company will win, no need to time the market perfectly, and no need to check prices every day. Setting up a small automatic contribution each month, even something as small as the price of a couple coffees, and letting it run untouched for years tends to outperform most attempts at getting clever with individual picks. Let's line all 5 results up side by side. Individual stocks landed at negative 32%, a reminder of how unpredictable picking single companies can be. REITs ended up around positive 10% once dividends were included, a steady if unspectacular result. Crypto exploded to over 550%, an outlier result driven by one of the best performing assets in recent memory. Gold grew about 40%, proving its reputation as a slow but dependable store of value. Index funds finished at nearly 80%, all without requiring any special skill or stock picking ability at all. Every single one of these has its own strengths and weaknesses. Some are built to grow your money quickly, but come with real danger attached. Others are built to protect what you already have, even if the growth is slower. There's no single correct answer for everyone, and that's exactly why understanding all 5 matters so much. Looking at learning curve alone, gold and index funds sit at the easy end, needing almost no ongoing study once the initial purchase is made. Individual stocks sit at the opposite end, demanding real research and ongoing attention if it's going to be done properly. REITs and crypto land somewhere in the middle, each requiring a bit of upfront learning before diving in. Looking at risk alone tells a similar story. Index funds and gold sit on the calmer end of the spectrum, while individual stocks and crypto sit on the wild end, capable of huge swings in either direction. REITs land in between, offering more stability than stocks, while still carrying some exposure to swings in the property market. And looking at tax efficiency, index funds, REITs, and individual stocks all benefit heavily from being held inside the right tax-sheltered account, while crypto tends to get taxed the hardest with the fewest shelters available. That's a detail that often gets overlooked, but over many years, it can make a real difference in how much of the profit actually stays in someone's pocket. If there's one lesson worth remembering from all of this, it's that starting early beats almost everything else. Even a small amount of money, like the $100 used throughout this whole test, can grow into something meaningful given enough time. That's the power of compounding at work, where your gains start generating their own gains year after year. Here's a simple way to picture how strong compounding really is. Picture 2 people. One starts investing $100 a month at age 25. The other waits until age 35 to start, but puts in double the amount each month to try to catch up. Even with all that extra money going in later, the person who started 10 years earlier usually ends up further ahead by retirement. Time in the market does more heavy lifting than almost any clever strategy ever could. You don't need thousands of dollars to begin. You don't need to be an expert either. What you need is to actually start, pick an approach that matches how much risk feels comfortable to you, and let time do the heavy lifting. The biggest investing mistake most people make isn't picking the wrong option. It's waiting too long to pick anything at all. A good way to decide where to begin is thinking honestly about two things. First, how would it feel to watch that money drop by half in a bad year? If that thought feels unbearable, leaning toward index funds, REITs, or gold makes far more sense than diving into crypto or individual stocks. Second, how many years can this money realistically sit untouched? The longer that timeline stretches, the more room there is to take on a bit more risk, since there's more time to recover from any rough patches along the way. None of these 5 options need to be picked exclusively either. Plenty of experienced investors spread their money across several of these categories at once, leaning heavier into the steadier options like index funds, while keeping smaller amounts in higher risk bets like crypto or individual stocks. That mix lets someone chase bigger growth with a small slice of their money while keeping the bulk of it protected and growing steadily in the background. The 5 paths we just walked through cover almost every common starting point a beginner runs into, from the wild swings of crypto to the quiet reliability of an index fund. None of them are wrong choices on their own. The only real mistake is letting that first $100 sit in a regular savings account doing nothing while inflation quietly eats away at it year after year. If you want to keep learning how to make your money work harder for you, check out the next video linked on screen. And don't forget to subscribe so you don't miss what's coming next.